everything you need to know about the price to earnings ratio, because contrary to popular opinion, this is not always the best ratio to use when analyzing and valuing stocks. The price to earnings ratio, it tells you how much a stock is being priced relative to the company's earnings, or relative to the amount of earnings that the business behind the stocks generate. We can see here that at the time of recording this, Microsoft has a price to earnings ratio of 25, which means that investors are paying $25 for every $1 of earnings that Microsoft's business generates. We can also see that JP Morgan has a price to earnings ratio of 10, which means that investors are valuing this business's earnings much less than Microsoft's and only paying $10 for every $1 of earnings that JP Morgan generates. Now, another way to think about the price to earnings ratio is the demand for the stock. So if the price to earnings ratio is higher, then it means that investors, well, there's just more investor demand for that business. And then on the contrary, if the price to earnings ratio is lower, then it means that there is much less demand for shares of that business.